Welcome back to our channel. Now we are discussing on ITAT ruling that share premium received from non-residents cannot be taxed under section 68 of Income Tax Act. A landmark ruling by the Income Tax Appellate Tribunal that has far-reaching implications for companies raising funds from non-resident investors. The ruling clarifies that share premium received from foreign investors, when backed by proper documentation and routed through standard banking channels, cannot be taxed under Section 68 of Income Tax Act 1961 as unexplained cash credits. We'll see the background of the case. The assessee in this case is a company engaged in developing vehicle tracking and telematics system. During the assessment year in 2018-19, the company raised a foreign direct investment (FDI) from existing non-resident investors in the form of share capital and share premium. So the AO assessing officer accepted the share capital but raised an objection regarding the share premium amounting to 6.87 crores. According to the assessing officer, the company failed to justify the high premium and hence treated it as unexplained cash credit under Section 68. The company, however, submitted comprehensive evidence, including valuation reports by independent professionals and investor bank statements, financial details of non-resident investors, RBI compliance, FDI filings, and prior year investment approvals by the tax department. So these documents collectively establishes the identity and creditworthiness and genuineness of the transaction. We'll see Commissioner of Income Tax Appellate decision. The matter went to the Commissioner of Income Tax Appeals, who examined the case in detail, and Commissioner of Income Tax Appeals observed that the non-resident investors were existing shareholders. All funds come through proper banking channels. Detailed valuation reports sustained the pricing. Accordingly, Commissioner of Income Tax Appeal deleted the entire addition of rupees 6.87 crore, holding that the company had sufficiently discharged its burden under Section 68. But the issue before ITAT, however, the revenue wasn't satisfied, is not satisfied. They filed an appeal before ITAT, raising the key question: even if the investors are non-residents and past investments were accepted, can such high share premiums still be taxed as unexplained under Section 68? This is the question. Issue before ITAT. So ITAT's findings. ITAT dismissed the revenues appeal and gave several critical findings, like established identity. So the non-resident investors were existing shareholders with full KYC, financials on record, and also creditworthiness proven. Funds came through foreign inward remittances and were supported by the bank statements and RBI compliance. And genuineness of the transaction, share subscription agreement and valuation reports supported the detailed structure. So importantly, the ITAT noted that similar FDI was accepted by the department in earlier years, and no adverse inference was done previously. Also, the tribunal clarified that Section 56, subsection 2, 7b, which deals with unjustified share premiums, does not apply to non-resident investors. Therefore, taxing the premium under section 68 was legally untenable. This is what ITAT observation. Let's summarize the key takeaways from the judgment. Foreign direct investment from non-residents, when backed by proper documentation, cannot be taxed arbitrarily under section 68. Valuation and RBI are key to avoid tax litigation on share premium. The bonus under section 68 stands discharged once identity, credit worthiness, and genuineness are proved. Section 56, subsection 27B does not apply to non-resident investors. This is a big relief for startups and raising global capital. This is a big relief for startups raising global capital. We have two channels, RR Corporates and RR Legal Talks. Please do subscribe and hit the bell icon so that you will not miss any of the latest updated videos. Thank you.